Dan to unmute there, please, and we'll kick off our webinar this morning, Irish Housing Market, February 2021 with Dan McLaughlin. For those of you that were on a moment ago, I may have referenced that Dan preferred to be known as Dr. Dan, and, but if memory serves him right, I think you were a goalkeeper, Dan. That was where you made your real name, was as a goalkeeper.
Not just a goalkeeper, a top goalkeeper, let's call it.
Goalkeeper. Okay, it's a great pleasure by myself and Graham to welcome everybody to our webinar this afternoon with Dan McLaughlin. And when we set up a number of years ago, it was very, very pleased that Dan became a member of our investment advisory board along with Helen and Dan. So we're always very grateful for that. Dan's work, as you'll sort of see go through here, you can follow Dan on danmclaughlin.ie, and I would recommend everybody who's interested in the Irish economy or in the Irish housing market to keep a track of the blogs that Dan does that. And indeed, because we're kind of young and trendy, I also follow him on Twitter, and he's a very active Twitterer, I think is what you refer to it as. As usual, the webinar is being recorded and it will be on our website from later on this afternoon. And as is customary with these things as well, we're delighted that Philip Barrett will be doing a sketch of the event. Questions, I will be monitoring the questions as we go through Dan's presentation, and anybody has any questions, just type the questions into the Q&A box at the bottom of your screen. If they are relevant to the topic Dan is in, I'll interrupt Dan and take them. Otherwise, we'll have plenty of time at the end, and Graham will say a few words at the end. So we're here to listen to Dan. Dan, it's a great pleasure to have you here today, talk to our clients. So with that, I'll hand it over to you.
Okay, thanks very much, Ronan. So welcome everybody. I'm going to have a look at the Irish housing market, and just going to have a look at what's actually kind of happened recently and the near-term outlook. But I want to put it in a kind of a broader in terms of a broader picture, because I think a number of changes have happened to the market in recent years, which are probably pretty well known. But I think the interesting thing is always that when particularly policymakers make policy changes, you end up with a lot of things that follow from that, and some of which are unforeseen. And so I believe myself that we're actually kind of drifting towards quite a different market than we think we have. Actually a more kind of German style housing market where if you're not familiar with that market, around half of households there live in rental property. So I think that what we can say about the Irish market in a broad sense is a number of points. One is that in recent years we've had very strong income growth, very strong employment growth, and most people believe that there's a kind of excess demand for housing because supply has not matched that increase in demand. The other thing I think is quite noticeable about Ireland is that it's quite difficult and quite expensive to build houses. I won't go into too much detail about that, but I have some examples of the cost later on. So. It follows, I think, therefore, that if it's expensive to build houses, then if people want to buy houses, they have to have relatively high incomes, or, of course, they have to access quite a lot of leverage. And that brings in the first big change, of course, is that was the case in the past, but since for the last 6 years, we've had mortgage controls, which essentially reduce the leverage, designed to reduce the leverage, of course, in the market for households. I think that's had a big impact because if the market is strong for housing, how much of that goes into rent and how much of it goes into house buying will be affected. And I think you're pushing a lot more people, of course, into the rental market. And I think the other thing that's happened is we have negative rates and QE, So the combination of that means that if you looked at a risk-free rate of return, say in the Irish market, let's say a 10-year bond yield, it's actually been slightly negative. It's gone marginally positive now, but let's say it's zero. So as a consequence, if you look at the Irish market and rental market in terms of an asset, you can see that maybe 4 or 5% rental return or yield is obviously pretty attractive. So that's attracted a lot of non-household buyers, institutional buyers. And as a consequence, that's a further squeeze on households trying to buy. And then the final thing is, if you put all that together, if you're trying to build houses, you have the cost of building it, you have the uncertainty of trying to sell it to people. So what's actually happening, of course, is that you can understand why that builders are selling off the plans often, blocks of apartments to institutions, because clearly from a builder perspective, that reduces significantly the risk of finding buyers in the end. But of course, that also means that we end up with a situation where the household are again squeezed and pushing more people into rent. So let's have a look at just what's happened in the market in the last couple of years. This is the CSO's residential price index, the annual change. And you can see, I think what's quite interesting is that the Irish market has actually underperformed in the last couple of years, because I think there was a lot of media attention to the fact that, house prices ended the year, they actually rose about 2% in December. And that, that was somehow a surprise. But if you look across Europe, house prices are still rising 4.5%, 5%. And there's specific reasons for that, which I'll go into. But I was just looking yesterday in the United States. For the past 5 years, the average price rise there has been about 5% per annum. But prices there in 2020 went up around 10%. So house prices generally in developed economies have been pretty firm. And if you look in the Irish one, as I said, the house prices weakened significantly, softened appreciably in 2019, before we moved into the pandemic. So, and that was largely, I think, driven by Dublin. So here is Dublin house prices and house prices excluding the capital. You can see the trend is similar, but Dublin house prices fell. In fact, in 2019, ended the year down about 2%, and have actually recovered a little bit in 2020, and have finished in marginally positive territory. So the Irish housing market has actually not performed particularly well for the last couple of years. But what's, I think one of the factors, of course, as I said earlier, is that if there's strong demand for housing, that can either go into house buying or people going into rent. And in fact, in our case, we've had a very significant and prolonged rise in residential rents. So this is the actual rents paid by people as measured by the CSO. And again, you can see in 2018, 2019, the market was pretty strong, started to slow a little bit, but you're still looking at 5-6% rise in the average rent paid nationally. But again, of course, in 2020, very sharp decline, even faster than house prices. I think a big factor there, particularly in Dublin, is the fact that a lot of high-income individuals that are working for multinationals often prefer to rent, actually, rather than to buy. A lot of them are from abroad. They don't envisage they're going to make a life here particularly. They're going to be here for maybe 4 or 5 years. So they prefer to rent, and often are from cultures that are more familiar with renting. And so the fact that we've had a sort of short-term exodus from the market, I think has had a big impact in parts of Dublin in terms of the rental market. Now, of course, that will reverse, I suspect, that, as Ireland starts to emerge from lockdown. So I think that's more of a short-term thing than a medium-term trend. But one of the peculiarities of the Irish market is, as I said, households, if they have employment and income, they're looking to move into their own accommodation, either with partners or people getting married. And so one of the interesting things to look at is how much does it cost what's the average rent per month in Ireland, and how much does it cost to get a new mortgage? And so this is a chart comparing the two. And in general, if you go back to the 1990s, in fact, rents were actually higher than the average new mortgage. And that tells you that mortgage was a scarce commodity then. And that was because the Irish supply of credit in Ireland was very different. There wasn't many lenders, and interest rates were much higher, of course. And then we move into the noughties and we get the credit boom, and you can see that a new mortgage was cost significantly more than cost to rent. And then we reversed again in the recent years. So that tells you, I think, there's something, there's something about the structure of the market, and there's some constraints in terms of getting mortgages. So what drives housing markets in general? And the answer is, on the supply side, obviously it's the supply of new housing. What I in my work that I've done and my equations that I try and use to look at the market, I find it's the housing stock per head that is the most significant factor, I think. So, that's obviously completions relative to the population, and some small factor for depreciation. And then on the demand side, you've got the main driver tends to be the growth in employment. That's the big driver, the changes in household income. Obviously, wages matter as well. But if you have strong employment growth, decent wage growth, that's going to be the prime driver on the demand side. Interest rates matter, but not dramatically so. And interest rates, what I mean is that, for example, short-term interest rates like mortgage rates, but also longer-term rates, because that affects the relative attractiveness of property as an asset class. And then, of course, the flow of mortgages. If the banks are impaired and can't lend much, as was the case after the crash, you're not going to have much mortgage growth. But banks are better capitalized now, and we're seeing some mortgage credit growth again. And the other thing that's very hard to kind of model or get your head around is price expectations, because clearly if people believe that prices are going to accelerate, buyers tend to bring forward their decision to purchase. And of course, builders are more likely to then start breaking ground if they believe that over the next year they can sell the house. They're fairly confident the prices will be a bit higher. And of course, that works the reverse. That tends to exacerbate any housing crisis, any housing cycle. So this is an equation I use based on those kind of things, which would suggest that house prices are not particularly overstretched relative to a lot of those fundamentals. In fact, they're maybe slightly cheap, maybe 7 or 8% below where they should be, which is also consistent with the belief of the central bank as well. So if we look in a bit more detail at some of the supply side, starting on the supply side. So this is the housing stock per 1,000 population in Ireland. And you can see clearly that there's been a big change in the last decade, because we had a prolonged increase in the housing stock relative to the population. To put it in perspective, the population is just below 5 million, of course. So, and recently we're getting sort of 50,000 or so increase in the population, which is like 1%. So you need at least, with the housing stock around 2 million, you need at least 20,000, excluding any depreciation, just to keep pace with that. Of course, we haven't seen anything like that until the last year or so. So consequently, the housing stock per head has been falling steadily. And that, on any housing model, would be a big factor pushing house prices up. A lot of, I'm sure people are aware, there's a lot of stuff been written about the fact that Ireland in general is perceived to have significant excess demand for housing. So a lot of work from different institutions suggesting that maybe we need 30,000 houses a year, 35,000 houses a year to match potential demand. I would say though that it's very difficult looking at projected growth, because a big factor in Ireland is net migration. So this chart shows you over the last 20 years or so. The orange line is the natural increase in population, which is births minus deaths. And then the blue line is net migration, which is obviously much more volatile. So in the noughties, or in the run-up to the crash, we saw massive increase in net migration. If you look at that figure, you'll see it's over 100,000, and then add in 40-odd thousand natural increase. So that's 140,000 increase in the population. And then, of course, it reverses, even though the population never fell, of course, because the natural increase is still exceeding the net migration outflow. But you can see that the natural increase actually slowed steadily, and it's only around about 30,000 at the moment. So currently we've got net immigrations picked up again to something similar. So the population clearly at the moment is outstripping, I think, the housing stock growth. But as I said, a big factor will be that net migration figure. And assuming the economy continues to perform pretty well, then there's kind of, most people assume that that figure stays fairly strong and certainly positive. As I said earlier, a big driver on the demand side is employment, and you know, you've got about 2.2 million people or were employed in Ireland. So you know, this is the annual change. The labour force survey is measured every quarter. So you can see that, you know, you've got 50, 60,000 steady growth in populations, in people in employment. You know, so that's well over, that's like 2.5% or so growth in employment per annum. And if you've got 3 or 4% pay growth, you know, that's 5 or 6% increase in household income. That's a steady, significant factor in driving housing demand. But obviously in the pandemic, we've seen a big fall in employment, although as I'll show in a minute, not quite as big as maybe some of the headlines would suggest. So we'll actually get the fourth quarter figure out tomorrow, I think it is. So you can see that in the third quarter, a big fall, fourth quarter, not so big annual decline. And it'll be interesting to see the final quarter. So on average, employment fell in Ireland last year, but probably maybe not as much as people might think. And it's interesting, the forecast for next year, some people think there will be an increase in, a further fall in employment, which would be negative for the market, but I'm not so sure that will actually occur. And one of the reasons they think that is the difference between these figures here. This is the actual unemployment figure as measured by the labour force survey. And that means that the households are asked, are you unemployed? Defined as I've been looking for work, available and looking for work. So if you take that definition, the Irish unemployment rate has hardly risen very much. It's gone from 100,000 unemployed to the last figure is about 140,000. So but this other rate on top, which is what's called the COVID adjusted rate. So that's the one that tends to get the headlines. But what that is the CSO is saying, well, if we take everybody that's furloughed, by definition, they're not classed as unemployed in the official definition because they're not looking for work, as it were. But if you add them in, you'll get this huge figure of 600,000. So they're not obviously unemployed in the technical sense. So what probably will happen next year or this year is that as people return to work, obviously the COVID thing will drop, but perhaps some firms obviously won't reopen, and the ones that do may cut back on employment. So we may see some pickup in the official unemployment rate just as the top rate the COVID one starts to decline. But what is quite striking, and as I said, is I think the main reason that the housing market has performed better than some people thought anyway, is the fact that, of course, the state has transferred huge income to people who have been furloughed. So consequently, this is the change in average weekly earnings, and you can see that generally Irish pay has been rising at sort of 3.5% per annum, but during the COVID, it's actually accelerated. That's partly because it's an average. So obviously, if you have fewer people working in a particular area, the average pay might be increased. But in general, what's striking about the whole COVID episode is that people who have been furloughed and the people who've lost their jobs are generally in areas where average earnings are much lower. And consequently, they wouldn't be in the cohort that would be buying property anyway. So as a consequence of all that, the fact that official employment hasn't dropped dramatically and that incomes are still rising, this is household disposable income, and you can see that clearly it's still rising about 5% per annum. And that's a big factor, as I said, why the housing market has performed, why some people thought, I think, house prices would fall very sharply, but given the fact that household incomes haven't fallen that much, or employment hasn't fallen that much, particularly in the house buying cohort, that I think that explains why house prices have held up better. So one of the oddities about the households, though, I think possibly a big factor in the market this year will be the fact that there's been a massive increase in what you might call forced savings. In other words, household incomes haven't fallen particularly, but the amount of what people would normally spend in terms of discretionary income has fallen significantly, simply because there's a lot of things that you couldn't buy that you normally would spend your money on. So consequently, this is the quarterly flow of savings, and household savings, and you can see that quite a dramatic change, particularly in the second quarter during the full lockdown. So to put that in context, what we tend to focus on in terms of looking at the household savings and consumption we tend to look at the savings ratio. So in general, in Ireland in recent years, the savings ratio has been around 12%. In other words, the average household, if you like, would be spending sort of 88 cents in every euro and saving 12 cents. So obviously that's an average. A lot of people don't have any savings, and other people would be saving much more than that. But the savings ratio jumped to 34% in the second quarter, dropped again in Q3 to 20%, probably came down a bit in Q4 again. But in general, you can see that one of the interesting things about what's going to happen in the next few years is how long will it take that savings ratio to go back to normal? If it goes back to normal quite quickly, then obviously you could have a massive consumer boom. And obviously also a lot of households have accumulated deposits for housing. I don't think people also are fully aware of quite the dramatic change that has happened in terms of the balance sheet of households. This chart here shows you Irish household loans and deposits, and the orange line is household loans, and you can see obviously during the Celtic Tiger period we had a ballooning of household debt, largely used to buy property. So it peaked around over 200 billion around 2008. And we've had 12 years of deleveraging. I think if you go back a few years, people that would be, kind of interested in this would have been thinking, how long will Irish households delever? And I don't think anyone would have thought it would be 12 years, but nonetheless, that is still the case. You can see that loans are still falling. They were about 200% of household income as well. They're now down to about 100, I think about 115 or something like that. But what's interesting also is how liquid households are now, because the blue line is household deposits, and you can see that household deposits, particularly, were rising anyway, but particularly last year have soared. So consequently, household deposits exceed debt by 33 billion. So an extraordinary turnaround from the position a decade ago. And of course, the corollary of that is a lot of households' deposits are in banks. And so one of the problems with the banking sector is that their loan to deposit ratio is now extremely, well below 100%. They have massive excess deposits, which of course is a problem in terms of their profitability. If we also look at interest rates, and there's a lot of attention in the media given to the fact that the average new mortgage rate in Ireland is one of the highest in the EU, which is true, of course, but that kind of obscures the fact that mortgage rates have never been lower. So the average new mortgage rate is about 2.77%, I think. That's an average. The average fixed rate is about 2.65. So mortgage rates have never been lower. So on that basis, mortgage affordability has also extremely good. This is a model I have which compares an average new mortgage, I'm assuming a 25-year mortgage. How much does it cost? So you're taking the average new mortgage rate, you're taking the monthly cost and comparing it to average income. So if you go way back to the mid-70s, you can see that the average is around 28.5%, 29%. But at times, mortgages are very affordable, like in the 1990s. People probably didn't think they were at the time, but they were. And then, of course, you can see clearly there the peak around as we approach the financial crash. So this is a 25-year mortgage, of course. So to get round that, of course, banks were extending mortgage duration quite substantially at that time because for people to be able to afford them. But if you take the latest figures, as I said earlier, if you take account of the relatively low mortgage rate, the average new mortgage is rising, but it's still well below what it was at the peak of the cycle over 10 years ago. And if you take account of the rising income, you can see it's still well below the long-term average. So mortgages are affordable if you can get them. And that brings me back to one of the points I made earlier. So if you look at a lot of metrics, Irish house prices relative to rents and so on, they're not particularly expensive, but what they are expensive to is in relation to earnings. So this is average house prices relative to earnings. And again, I've put the long run average. And you can see clearly the Celtic Tiger period, first half of the noughties, we got a massive increase in house prices relative to earnings. Then we get the correction. But house prices, again, are expensive relative to average earnings. So the corollary of that is, of course, that for an individual to buy a house, you need either pretty high income, well above the average, or you need significant leverage. And that's because, as I said earlier, it costs a lot to build a house. This is figures from the Chartered Surveyors from Ireland. And so this is from 2020. How much does it cost to build a 1,200 square foot house? You can see roughly it costs 370,000 according to their figures. But what's striking, of course, is the construction costs are how low they are as a proportion of the total. So 179,000 to actually build a house. And it's a lot of the land acquisitions, obviously a big factor as well. But there's a huge amount of additional costs, particularly professional services, which add a huge amount. And then, of course, you've got VAT on top of it. So the builder margin they're assuming here is 15%. So what does that mean? It means that if an average house in Dublin costs 370,000 to build, to sell, that I need, I can get a 90% mortgage. So that's, I need a 334,000 mortgage. And if the loan to income is 3.5 times, then I need an income or a joint income or whatever of 95,000. And also I need a 10% deposit, which is obviously 37,000. So those are the two big constraints that you need. You either have to have much higher leverage, or as I said, net result is that the average person on average income can't really afford to buy a house. So one of the odd things, as I said, about policymakers make changes, but what often happens is that sets up a chain of events. So if you look at the Irish case, what the government is trying to do is to say, okay, we want, for political reasons, we want more first-time buyers. So we can't do anything about the central bank, but what we can do is try and boost the income of first-time buyers. So hence you have the Help to Buy scheme. So in other words, you have a set of controls, and here you have the government essentially trying to kind of circumvent them a bit by boosting the income, if you like, the purchasing power of first-time buyers. How they do that is the Help to Buy scheme. So people are probably familiar with that. It was the case you could claim up to 20,000 income tax back over the last 4 years, and use that as a deposit to buy has to be a newly built house. Have to be a first-time buyer, and they've just extended that to the end of 2021 to 30,000. So again, trying to boost the income of first-time buyers in an effort to kind of essentially get around the leverage issue. And the other thing that's been proposed, just briefly, is this affordable housing bill, which essentially will mean that the government will be buying houses, because it will be, the detail is yet to be agreed, but it will be paying perhaps up to 30%, or providing 30% equity into the purchase price. So essentially, the state is buying houses and in another attempt to boost the buying power of first-time buyers. So if we look overall at, we can see mortgage lending. This is the mortgage loans for house purchase. This is the total volume. You can see that has been steadily rising, but relative to where it was, pre-crash, it's still pretty low. And one of the main factors, of course, is that there aren't that many houses to buy. So, if you look in 2019, we got about 34,000 mortgage loans for house purchase, and it dropped below around 28,000 last year for the full year. So that's a 16% fall. And as I said, house completions are rising, but still relatively low to where they used to be, of course. I mean, at the peak, famously at the peak of the boom, there was over 90,000 houses built in 1 year. So here we are, you go back to 2017, you're talking about 10 or 11,000 houses built. So 2019, it went up to around 21,000, and 2020 turned out to be a bit better than the industry was predicting. Some people were thinking 16, 17,000 at one point. It ended up over 20,000. But again, the expectation, a lot of the models would just take it as read that you're going to get a very significant and steady increase in housing supply. I'm not as convinced about that myself, because for this reason, that because the central bank mortgage controls exist, that essentially means that house prices now are more or less constrained around the rise in household incomes. So if household incomes are rising, say 3, 4, 5% in a good year, then consequently house prices will be tending to rise at around the same level. So, and if household income growth slows, then so will house prices. So to me, unless you get, I think, a significant acceleration in house prices, I'm not so sure that we'll get the steady increase in housing supply from the private sector that people seem to think will happen. And as I said, if we look at the central bank controls, this is first-time buyers' loan to income. And so if you go back to the pre-crash period, you can see the median was around something like 4.4, but the top 10% of people getting loans, it was about 5.7, 5.8. So much higher leverage. And you can see right now that the average loan to income in the Irish mortgage market is 3.2. That is the lowest in the euro area, and the average in the euro area is 4.4. And in fact, in Austria and Belgium, I think it's over 6. So that means that clearly that's had a huge impact on the market, that pushes far more people into the rental space that would have been able perhaps to get a mortgage in the past. Now, obviously, this is pretty, this area here, things went a bit horribly wrong, but now we have a situation where there's very little leverage allowed in the market. And of course, we have just been announced that we have essentially got 5 main mortgage lenders for residential mortgages, with a few smaller ones thrown in. Although we're just about to lose one of those, so that's also probably going to constrain the market further. Under the central bank controls, banks are allowed to exceed the 3.5 LTI for first-time buyers. They have 20% of their lending can be above it. But this one of the problems with the controls is that you get a situation where banks are careful through the year it's a full year figure, so they have to be careful through the year not to go too mad early on. So this is 2019. You can see you get up to around 18.5% of loans are exceeding the 3.5 LTI. But you can see, I suppose, naturally enough, as we went through 2020, you get banks becoming much more cautious, and a very significant fall away in the amount of lending that exceeded the 3.5. As I said earlier, if you put all this together, if we look at who's buying houses, you can see that if households are constrained by lack of leverage relative to the longer term norm, and indeed relative to the European norm, but as a consequence of negative rates and QE with very low or negative bond yields, then that makes a rental yield of 4 or 5% pretty attractive. I was looking at the IRES REIT results the other day, and their gross rental yield is over 5.4, I think it was. So that's a very attractive rate of return in this current world we live in. So consequently, we've had a very significant increase in non-household buyers. So yeah, that's about 23, 24% of the market. So again, what are they going to do? They're going to be buying property, often, as I said, direct from before completion now, and renting it out. So again, further squeezing the household buyers. So a consequence of all of that is that Ireland's often thought of historically as, a society where owning your own home is deemed a very desirable thing. But if we look back, you can see that home ownership peaked way back actually in 1991 and has fallen steadily since. So as I said, I'm not sure we'll get down to 50%, but we're certainly kind of drifting that way. And the point I'm trying to make in all of this, in a way, is that if policymakers or the electorate had kind of sat down and said, right, this is the model we're going to aim for, I don't think that's ever happened. It's so the central bank brought in the controls. The corollary of the controls, of course, is you're going to have lower house price growth, lower credit growth, lower supply of housing, and a greater number of people being pushed into the rental market. But I'm not sure if you said that to the government in 2015, that seemed to be pretty likely corollary of all that was happening in terms of the controls. But I don't think that kind of was obvious to certainly policymakers at the time. And also what it means, of course, if you added all this up, is that the only way really that we're going to get very significant people into the housing market is that we're going to have a huge amount of social housing. And that's essentially the way we're going as well, but starting from a very small base. I mean, social housing collapsed from 2010 onwards anyway. We were building less than 1,000 a year at one point. The government has big plans for social housing, but again, if you look at the detail, they're planning to actually buy a chunk of the housing for social housing, which means, of course, it has to be built. And if it's built and bought by the government or the local authorities, then it isn't going to be used in the private sector. So to sum up, I think what I'm trying to show is that Ireland is... There was a central bank report on Irish housing years ago which said the Irish housing market is pathological. So I wouldn't go quite that far, but it certainly kind of has a lot of unusual features. As I said, if you start with the idea that it's actually difficult and expensive to build housing in Ireland for private sale, you add in the fact that that means you need high leverage for a lot of people to buy it. If you don't allow that high leverage, then you're going to end up with a lot of people in the rental market. And finally, if you have a financial environment as a consequence of ECB policies in terms of QE and negative rates, then that's going to make institutional purchases of property for rents much more attractive. That's a big change if you go back to the Celtic Tiger era, where there was very little foreign kind of interaction with the Irish housing market, very little foreign buying of the market. But I think that's a big change this time, because in those days, of course, rental yields were lower, and of course the bond yields were up at Irish 10-year bond yield was up at 4 or 5%. So big changes. Okay, I will leave it there and back to Ronan if he has any issues.
Thank you, Dan. I enjoyed that thoroughly, and I like the slides. We'll send out the slides to everybody later on. Can I come back to, we have a number of questions building, and I'll come to them in 1 second. Some of them might be slightly beyond, well, nothing would be beyond your pay grade, Dan, so that wouldn't be quite the right phrase there, but there might be your area of expertise. But nonetheless, I think people would be interested. But can I come back to some of the last points that you mentioned? Because I suppose in this coronavirus world, very few other things are getting a look in. And last week, the Banking and Payments Federation brought out the report, capital requirements for the Irish banks being 3 times that of the European average. And there was further hint or nod to the point that you made in terms of our loan to income ratios being significantly lower than other people. Yeah. I actually came to the conclusion that was about 2.5 billion of lending not taking place that would otherwise take place. So is that our central bank that dictates those rules? Or it appears as if, even though we've got a higher quality of lending now, we're still fighting the last war?
Yeah, no, I think it's a mixture of the two. What they're talking about, you mentioned, is the risk weighting. Irish mortgages have a risk weight of about, I think on average, they had 37%. The average in the EU is about 13%. In the UK, it's about 10 actually. So Irish risk rates are very high, which means obviously you have to hold more capital against any given mortgage. And that's not so much to do with the Irish central bank, that's to do with the kind of European banking authority, the way they look at risk weights. And they brought in a thing recently to try and get risk weights across different banks to be more aligned. And that essentially gives a lot of weight to past losses. So Ireland essentially is still paying the price for the big losses a decade ago. So that's partly, so that's a European, if you like, phenomenon rather than central bank phenomenon. But there's another specific Irish phenomenon which maybe didn't get as much media attention, which in itself tells you a lot as well. It takes on average almost 4 years to repossess a home in Ireland, or a house in Ireland, which is again way beyond the norm. And as a consequence, they had I thought it was quite an astonishing figure, that on average across Europe, banks can recover about 45% of a housing loan gone wrong. In Ireland, it's 11%. 11%. So that also, when you work out the amount of capital you need for a mortgage, it's partly how many people, the probability of default, but it's in total, it's called the loss given default. So if I default, how long is it going to take the bank to repossess the home, sell the home, and get some money back? This is supposed to be a secured loan, but if you can only get 11% back, that's massively increasing the risk weight as well. That's obviously nothing to do with Europe. That's just the way our system works. It's very time consuming. It's very difficult to get repossessions. And you might say, okay, that's, Irish society has decided that it's not a good thing that, a bank can come along and take your house. That's a decision for Irish society, but there will be a knock-on effect. And so that knock-on effect is it's much more expensive to get a mortgage.
Okay, thank you. We'll start taking the questions now. The first question is in two parts, and I'll just read it as it is. And it's obviously, you'll notice from the question it centers around our head office, which happens to be in Naas, where we are, and Dan and Graham are in our Dublin office. So this is the development for Naas will be out shortly. And the word is out that no more land will be rezoned and that some residential lands will be dezoned. This will put the price of new homes up and create a shortage of residential zone lands. And this is caused by the management of the process by central government. Okay. And then I suppose, as I say, it's a difficult question. So any views on that? Now, clearly it's not specific to Naas, but it's about the whole central management process of zoning lands.
Yeah, well, it comes back to the fact that I said right at the start, it's actually not really expensive to build a house, but it's actually very difficult. And so we have this kind of weird thing that it's kind of accepted that we need to build a lot more houses. But then, of course, when anyone tries to build them, you're going to be building them in the sense next to somebody else who already has a property there. So there's a huge amount of resistance. And I think, it's difficult to get the balance right, because clearly in the Celtic Tiger boom, there was a lot of houses built in areas where they shouldn't have been built, not only in terms of having people living there, but also in terms of not having the right infrastructure. But yeah, you know, the system is in a bit of a mess, and it's just very difficult, I think, and expensive to build houses. So, but you know, that's why I'm not as maybe that's optimistic that, you know, if you look at the Department of Finance or the central bank or the ESRI, they think they'll be like, in 2 years' time, we'll be building 35,000 houses a year. I'm not so sure about that.
Okay, all right. Is it this, and I'm taking the questions in sequence and are starting to build up a little bit more. Affordability is impacted by mortgage interest rate. Dan commented, interest rate is not high against long-term average, but it is very high compared to the most of Europe. How can banks and government justify this? Income isn't the only factor limiting affordability. Now, I know you touched on some of that, but you may just have a few brief comments.
Yeah. Well, that's an interesting question in a way, because if you looked at the Irish media coverage of banks, you would see that they generally feel that banks make too much money, and a lot of attention given to the fact, as the questioner points out, that Irish mortgage rates for new mortgages are actually very high relative to the European norm. Part of that reason is to do with the risk weighting, as I said earlier. Part of it is legacy. I mean, what people probably don't realize is there's still over 40,000 mortgages in arrears in Ireland for PDH mortgages in arrears. That's like 5.5% of the total. There's over 50,000 in arrears if you put in buy-to-let. So, you know, that's still an issue. But also, a big problem for Irish banks as well is the legacy of the tracker mortgages. I know obviously there was a huge issue about them having, that they had to pay people back for, they shouldn't have taken them off trackers. But, you know, about 40% of the existing outstanding mortgages are trackers. And the average interest rate on those is 1%. So for an average bank, they might be 40 basis points, say, cost of funds. So that's a 60 basis point margin. So another reason why they have trying to make that money back is the higher cost of the putting higher rates on new mortgages. But as to go back to what I started with, the irony is that if you look more closely at some of the central bank stuff, and if you look more closely at the ECB stuff, they are worried that banks don't make enough money. And if you're an investor, if you looked at Irish banks, yes, they've had a very good rally in the last 3 or 4 months, but they're still trading below less than half of the net asset value. So there's a lot of reasons, partly Irish, partly European, why Irish banks don't make much money, and that's their attempt to try and remedy that by trying to charge people more for new mortgages. But another factor is lack of competition. You know, as I said earlier, there was 5 mortgage lenders. There's probably going to be 4 now, which is going to make competition fall, of course. And you know, so that's not going to put downward pressure on mortgage rates at all. It's going to the other. But if you looked at Ulster Bank's loan to income ratio, cost income ratio is like 90%, and its return on capital is like 2 or 3%. So if you, other than sentimental reasons, somebody has looked at it from a business perspective from NatWest and said it doesn't make any sense to be here. The final point I would say, it's a very hostile political climate for banks. There is no, I mentioned earlier the time it takes to repossess a home. There is no TD going to stand up in the Dáil and say, I'm bringing in a bill to make it easier to repossess a house. It always is a hostile environment for banks. So, you know, banks have made, I'm not defending anything banks do, they've made a lot of mistakes, and obviously they deserve to be fined for all those kind of things. But I'm just saying it is an unusual climate here for banks.
Okay, thank you, Dan. The next one, we'll move on. If we move to a lower home ownership model, what does that imply for the savings rate and post-retirement incomes? Not absolutely sure what the questioner is getting at, but that's the...
Well, I mean, for a start, housing is still, and I mentioned the fact that institutions are buying. Just in passing, by the way, if an institution was buying a mortgage book in the UK, they wouldn't be called a vulture fund. So that term itself tells you the attitude to the things. But anyway, so institutions are obviously buying rental property for the yield, but that also applies to individuals who can afford it. So people with the savings to buy property, that's what would you look for in terms of a relatively low risk yield? And you'd normally look for a government bond, and if that's zero, if you've getting 4.5–5% on a rental yield, that's going to make it much more attractive for high income or people with the savings that can afford to buy property. I think possibly that's what they're getting at. And unless the leverage rules change, I think that's going to be that's going to continue. That institutions and people, individuals with higher incomes or savings, will be buying property to rent.
Okay. Do you have a view on commercial property in Dublin?
I haven't looked at it too closely. I mean, it tends to be much. The problem always with commercial property is that it's housing markets, residential markets are volatile and cyclical. Commercial more so, because got quite a long period between supply and demand, and also demand can change much more rapidly. So we've had obviously a massive change in demand in the short term. So obviously there's a huge rise in vacancy rates and so forth. But in the medium term, I don't think there might be excess supply in the short term, but in the medium term, I don't think there's any reason to think that the Irish economy will do anything other than performing pretty well, and particularly with Britain out of the EU, probably continue to attract multinationals, even in the tech space and so on. So short term, it certainly suffered much more than residential. But as I said, I think as hopefully we move back to a more normal environment in 2022, maybe even now, then that is, as I said, likely to unwind. Okay.
Now we've one other question, and then we come on to actually a few from social housing. So Graham might come in on those. Well, if Ireland trends towards German rental model, how do you see the retired affording rents, particularly with unfunded pensions? So there's a lot in this question. Is there a problem brewing?
Well, the reason rents are high in the private sector is the reason I said earlier, that if you have strong income growth and people, a cohort of people on relatively high incomes, which you have had. I mean, if you just think of it this way, people often say somebody like a guard or a nurse, 20 years ago could afford to buy a house, and they can't now. But the reason is that 20 years ago, you didn't have Google, or you didn't have Facebook, or so some of them didn't even exist. So you have a huge area of the economy where people are employed in relatively well-paid jobs, and consequently, that's why rents in Dublin were particularly high. So is that going to change? And the answer probably is no, unless something dramatic happens in terms of, a mass exodus of these companies. that's unlikely to change. So therefore, you come back to the thing that the only way you can provide the kind of housing at, let's call it, an affordable level, either rent, particularly for rent, is some kind of social housing, much more social housing model. And other than that, it's hard to see why there would be a great change from what's happened in the last few years.
Well, and that is a great segue into the next two questions. And Graham might want to come in. On the social housing, do you believe the current appetite by the local authority to rent on longer term leases rather than acquire outright is here to stay? Is it value for money? That's the I'll put the two of them together if that's okay. That's the first question. And the second one is, my question is related to the housing, is to social housing section. The social housing development is funded by the government via the AHBs, which somebody might explain, and the leasing schemes. And the contracts for lease are typically 25 years long. The rental income is capped at 85% of the market rental value, and some of which is paid by the government itself via the supplement welfare allowance. Quite a detail. What will be the exit for the government's investment here, since the investment is high, leases are long? So there's obviously two questions there. That second one is obviously quite specific. So first one, is there value for money, and is it here to stay?
Yeah, I might come in there, Dan, if you don't mind. And that was a very well-researched presentation, and Dan has clearly done his homework. Well, I've done mine, but I'm not sure I'd get the gold stars. And Santiago Capital is a lending business, a property lending business, and we work alongside Santiago Investment Advisors, which is a wealth management business. And this presentation is really A intersection B. It's where the two subjects meet, and the housing market is of great interest to probably most of our clients. For Santiago Capital as a lender into Irish property over the last 3 years, we have had our eyes opened by the appetite of the approved housing bodies to acquire social housing. And there's an extraordinary infrastructure there between the CAF scheme and the HFA scheme, and local authorities all coming together to acquire social housing. And that's probably in large part because there's so many people who cannot get mortgages, or who cannot get mortgages large enough to buy the houses. So there's kind of a circular relationship here between what's happening in the private sector and what's happening in the public sector for property. So to actually try and answer the question that Ronan just posed, it's my view that the government or the local authority are entering into leases at 80% or whatever the cap is on the market rent, but they are in some ways also the market, because they're soaking up so much supply for the long term that they're nearly crowding out to some extent the private rental market. And I often wonder what would happen to rents if the government withdrew completely. Maybe rents would come right down, and we'd all be able to afford them. So it's interference in the market in a way. And to try and answer the question, what will they do when they come off their 25-year leases? I suspect they'll roll them. And I think, kind of picking up from Dan's presentation, so what I'm seeing on the ground as we lend money and trying to knit it into Dan's presentation, which is analysing the data, that it's very manifest that there is a shift into social housing and into rental housing. And there's schemes that are purpose-built for REITs that would have gone to the private market in days of yore. And I see no sign of that trend changing. Now, Dan, I'll let you say your bit there. Hopefully you're not going to contradict me, but speak your mind.
No, fully agree. As I said, making the point myself, that you have a huge, the REITs are just one of the institutions buying. Or just making the point that the reason they are buying is also maybe not fully comprehended. That so I always find it interesting that there's a massive amount of attention in the media and in politics given to fiscal policy. That, you know, minute examination of the budget, even though it has, for most people, very marginal changes to their income. And yet, nobody ever seems to ask the central bank in the Dáil about the impact of QE on the Irish housing market. It seems to me pretty obvious impact, but nobody ever seems to connect them. And of course, you know, the reason why governments intervene is because if you looked at an economic textbook, they'd say it's because there's a market failure. But I don't think it's much as market failure here, but to reiterate something I said earlier, that what I think is striking in Ireland is that, say, the central bank brings in controls, and essentially the government is trying to circumvent this controls by introducing its own things like help to buy. And of course, they even did a rebuilding house loan, which was extraordinarily generous. And to get it, you had to be turned down by 2 lenders. So you had to be a subprime borrower at a much lower interest rate than anyone else would get. Plus, you could get up to around 5 times your income. So that was clearly, it's only a small number of people, of course, but yeah, so I think the market is, I used the word, or the central bank years ago used the word pathological, but yeah, it's a kind of very fragmented and odd market.
Okay, thank you. Now, I'm very conscious of the time, and we still have a lot of people, so we've 1 or 2 questions, so I appreciate everybody staying with us, which is excellent. Thank you for that. Two very quick ones, and then I'm going to have a really lovely question for at the very end, Dan, from clearly somebody who knows you very well. What do you think the COVID work from home practices, do you think the COVID work from home practices will have a long-term effect on property ownership rent in Dublin? And allied to that, then there's another question which we may have touched on. What are the key factors in deciding the purchase of a new build? Is it predominantly the rental yield? Clearly a lot of things, who's buying it. The work from home practices you might touch on first.
That's a big question, isn't it? I think there's a lot of debate around that. I don't think it'll be a dramatic exodus from Dublin, simply because there's another related problem, which is that I don't think Ireland throughout the country has the communications required for a lot of people to effectively work from home, but particularly in an awful lot of places still broadband is terrible. Like I myself live not far, just outside Shankill, and the new fibre thing came to Shankill, but it stopped there, and my broadband is very poor, which is why I'm doing it from here, and why my name is Graham Crowley. I'm doing it from Graham's thing. So I think that's maybe an underappreciated thing, that, you know, we'd all like to live on a beach in Kerry and work from home, but I'm not so sure that would work out as well. And then the other thing is an awful lot of jobs you can't do that. So I don't think it'll be as pronounced as my own view, but clearly that's you know, it'll be an interesting development. It may be slightly different in other countries which don't have the same. You know, if you looked in America, you could say, well, why are people in New York? But you know, they tend to still gravitate to big cities because there's kind of economies of scale that tend to manifest themselves. The other question was about rental yield.
Yes.
Well, I think that's obviously a big factor, but you know, the more buying there is, of course, and conceptually you'd be driving down the yield. But still, like, if you look at the rental, if you look at back in 2007, on my figures, like the rental yield had fallen below the mortgage rate. So by definition, the only way, you know, that would imply that people are implicitly looking for capital gain. Otherwise, you know, why would you be buying the thing? So that's we're so far off that now. I mean, the gap is quite extraordinary. I mean, 5% rental yield versus 0 10-year government bond yield. That's a huge incentive. And as I said earlier, from a builder perspective, why not sell it to a confirmed buyer before I complete it or even start building it? Because there's so much, as we know, the problem always with housing is one of the problems is the gap between I'm going to start looking for planning permission and when I finally sell the last apartment that I've built. I mean, that can be a long period, and a lot of things can happen.
One last question for the moment, and then this person obviously knows you very well. So, on a 5-year view, 1 million in a global equity ETF or 1 million 4-bedroom semi in BlackRock, which is the best investment? And I have the luxury, Dan, of knowing who's asked the question, and you don't. So that makes me feel very.
Oh no, yeah, I would. Sorry, what was that? A global ETF? No, I'd say equities outperform. Yeah.
You didn't do that. Thank you for that, Dan. Okay. Okay. So, unless we've any other questions, Graham, I might ask you to say a few words if you don't mind, and before I wrap up and thank Dan again.
Well, thank you, Dan. I've already flattered your presentation, and I meant every word of that. And I know you meant every word of the presentation. We have a lot of new listeners or new people to Santiago, whether it's Santiago Capital or Santiago Investment Advisors, tuned in. Well, according to the bookings anyway, I didn't actually see who turned up on the day. And just to say that Ronan and I both would be very open to conversations, whether it's to discuss a borrowing requirement, and we are able to invest in loans as well in Santiago Capital. So if we're making loans for social housing, we do place third-party capital along with our own capital. And then on the investment advisory side, well, the question about affording your rent and having your pension underfunded came up. So in this day, it's incumbent on us all to make sure we provide for ourselves in the future, and that can require putting pension structures in place. And that is something we'd be delighted to talk to you about as well. So let's start a conversation. And thank you again, Dan, and thank you everybody for tuning in.
So as I said, we will have a recording of the webinar. Will be on the website under our under the news and events section. We have revamped all of our webinars there. I'd urge you to go and have a look at it. It's a very attractive page. We will have the sketch, and just to reiterate what I said, following Dan on Twitter is a very worthwhile exercise. His coverage of the Irish economy and indeed the housing market remains second to none. So with that, thank you everybody for your time this afternoon. We really do appreciate you coming out in the tremendous numbers again that we had. And with that, I just make one final point, Ronan. Yes, Dan?
The Premier League title is not over yet. That's all I'll say.
I generally try to behave presidential in these meetings, and despite provocation from the panelists, I'll just sort of reiterate what a wonderful performance Chelsea had last night, and I think we have a big match coming up at the weekend, Dan. So I don't think all the many people want it. We shall take this off air, as they say. So with that, I'll bring the meeting to a close. Thank you all very much.
Thank you, folks. Take care.
Thank you.